A massive margin call heard round the world, a massive plan for trillions in government spending, and that massive rollout of the COVID vaccine, all dovetailing with end-of-the-quarter portfolio rebalancing, keeping traders on edge in a short but busy week. This is Bloomberg Wall Street Week. I'm Romaine Bostick, in for David Weston. This week, contributor Larry Summers of Harvard.
I defy any serious analyst to suggest that an excess cost of capital is an inhibition to any important private investment in the United States today.
ECB President Christine Lagarde.
We have a mandate, we have an aim, we're going to be riveted to that.
Jurien of Fidelity. Barry Knapp of Ironsides. Paul Sankey of Sankey Research.
Europe is actually the tightening mechanism on the entire global oil market, which we've really never seen before.
Margaret Anadu of Goldman Sachs. A sudden multi-billion-dollar liquidation of stocks held by Archegos Capital. This after the little-known firm of former hedge fund manager Bill Wang defaulted on margin loans. While some lenders like Goldman Sachs and Wells Fargo were able to cover their exposure, other banks, including Credit Suisse and Nomura, are said to be facing impairments, and now regulators are asking how such a blow-up was allowed to happen. Meantime, Wall Street is also focused on the impact of more U.S. fiscal spending. This as President Biden pitches that Build Back Better infrastructure proposal that comes with a price tag starting at $2.25 trillion.
It's big, yes. It's bold, yes. And we can get it done.
President Biden also signaling progress on COVID vaccinations, saying 90% of U.S. adults will be eligible to get a shot by April 19th. The announcement, though, overlap with stark warnings issued by the CDC about a rise in new coronavirus infections.
I'm going to reflect on the recurring feeling I have of impending doom.
And the first quarter of 2021 is in the books, a fourth straight quarterly gain for the S&P 500, but that reflation trade in equities, it was at the expense of bonds, treasuries posting their worst quarterly loss since 1980. We asked our roundtable of Jurien, Director of Global Macro at Fidelity, and Barry Knapp, Managing Partner of Ironsides Macroeconomics, to draw a trend line from what happened in the first quarter to what folks should expect in the second.
The overall economic momentum looks considerable. My core thesis for this year was there were going to be three big drivers of growth. Those would be a recovery in global trade and manufacturing, not just from the pandemic, but from the trade war, which caused the global trade and manufacturing recession. That trade war also dampened business confidence and hurt capital spending, which had originally been quite strong after the passage of the Tax Cuts and Jobs Act. So we should recover from that as well. And you've seen a lot of evidence in the first quarter that capital spending plans are increasing. R&D spending for the S&P 500 picked up. So all those things should be quite strong. And then the reflation trade, which is the price effect of both these things, is increased or is certainly evident when you look at inflation break-evens, five-year forward, that inflation component of bond yields has continued to go higher. So for me, those core three themes that I thought would be the big drivers of equities through the year look intact. There's been no real setback there.
So, Jurien, let's stay on that theme of the reflation trade. Then we did get new projections out of the WTO saying they're looking at now an 8% jump in global merchandise trade this year, another 4% next year. You have companies like Samsung, Taiwan Semiconductor saying that they're raising cap spending. It seems like all the elements there for that reflation trade seem to be there. Any risk, though, that are on your radar?
Well, the markets have been very, very efficient, as they generally are, in discounting this reflation, right? And we saw it in the growth to value rotation, which is ongoing. We've certainly seen it in the bond market. A year ago, the 10-year was at 0.5%. Now it's at 1.7. Real yields have risen along with inflation expectations, as Barry just mentioned. And the economy, by all accounts, is going to be running hot. And both on the fiscal side and the monetary side, policymakers will let that happen because the gap between the broader unemployment rate, the U6, and what's considered, full employment is still 6.6 percentage points, which is a very large gap. And again, I've talked a lot about in the past that the 1940s analog to me is actually very relevant, even though we don't have a world war, obviously. But the mobilization, the fiscal spending, the debt increase, the fact that the Fed completely monetized that debt by expanding its balance sheet, tenfold, and capping bond yields at 2.5, and allowing inflation to run hot, and therefore pressing real yields to negative levels. I think that's still a pretty good playbook. The risk, of course, is that the Fed, which is trying to convince the bond vigilantes to go home and not press rates, beyond 2%, if the Fed loses the narrative on that and inflation expectations become entrenched, which is not a prediction at all from me, but if that were to happen, then I think the policy risk that Barry mentioned could start to seep in, and it might be hard to put that genie back in the bottle.
I am curious, though, about whether the market really has the kind of oomph that it did in the past to really push back on that. I mean, we've seen Jay Powell sort of hold his ground. There was a great interview on Bloomberg television this week with Christine Lagarde, where she basically said, come and test us if you want, but you're not going to win, that we have the tools to basically do what she wants to do, Barry. I am curious as to whether you think there are those sort of proverbial bond vigilantes or even market vigilantes out there, and whether they have enough power to really push back on this.
I do, actually. And to me, one of the most fascinating events of the first quarter, I think is a little bit underappreciated, which is when you look at the real yield part of nominal Treasury yields, prior to the global financial crisis, the biggest driver of that was market economic expectations. We used to use it as something of a proxy for market implied growth. After the global financial crisis, that became all about Fed policy. The taper tantrum triggered a huge rise. We had the two real rate shocks in 2018 when the Fed was contracting their balance sheet, one in January and the other in September, both of which triggered serious risk off and equity market corrections. Since January 5th, what I've observed is a real steepening of this real rate curve beyond the point of where the Fed is purchasing. So it actually looks like the expectations of government supply, Treasury supply from the 1.9 trillion, 5.3 total, and now another planned 4 trillion spending are actually moving interest rates. This is the first time in my career, going back to the early 80s, where you could really look and see supply expectations move rates. So it's early days on that. We haven't reached our borrowing limits yet. But I found that was just fascinating to see the market move on those supply expectations. So we'll see how the next plan goes and whether the market acts similarly. But there's a few vigilantes left, I guess, is my message.
And I agree with you, Barry, that real rates really is the key indicator here. If yields continue to back up, but it's driven by inflation expectations, I think the Fed would bless that. I think the market would be fine with it, because that would imply that real yields, at least on the short end of the curve, will continue negative. And I think that's a critical component of the reflation, which you kind of need to get out of all this, to pay for all this debt. But real yields, you remember, Barry, the 2013 taper tantrum, real yields shot up 150 basis points plus in 6 weeks. That's a real shock. So far, they've only gone about 50 basis points. But to me, that's the thing I'm following the most, that if that continues and it happens rapidly, especially in a much more growthy stock market than we were in 2013, that can be kind of the thing that ruins the party a little bit.
Well, then when we talk about inflation, the specter of inflation, the threat of inflation here, does this sort of produce the type of inflation that, I guess in the words of Jay Powell, is going to be transitory? Or is this going to be something that's a little bit more entrenched here in our economy going forward?
My response to that would be, we are going to get a transitory effect in the second quarter that the Fed will look through. My broader inflation outlook, though, and again, I don't think we're going to, I like the 60s analog, Jurien, actually, rather than the 40s. But my idea is that the main source of disinflationary pressure for the last 3 decades has been global goods prices, right? Core goods prices. That is largely a consequence of going from 750 million industrialized workers in 1990 to 2 billion by 2010, with the integration of China and the Soviet bloc into global supply chains. I am expecting far less disinflationary pressure as global supply chains are restructured from just in time to just in case, right? I mean, Intel's decision to get into the foundry business is an example of that. The Suez Canal is yet another, supply chain shock, right? So if we do start to restructure supply chains and we don't get that persistent disinflationary pressure from goods prices, then the long-term outlook for inflation starts to rise.
I was just going to completely agree with you, Barry, that the 1960s is also one of my favorite analogs. And what's interesting is that, rates and inflation were low for long through the 50s, through the early 60s. The bonds to stocks correlation bottomed in 1960. It crossed over to the positive side in 1964. Then we had this, nice blow off in speculative sentiment into the 68 secular peak. And so there are a lot of similarities between now and the 60s. And again, inflation didn't really happen all at once until the 70s, but it happened slowly in the second half of the 60s. So I agree with you, Barry, that there are some good parallels there.
That was this week's Roundtable with Jurien Timmer of Fidelity and Barry Knapp of Ironsides Macroeconomics. Coming up, taking on too much. We go inside the unwinding of Archegos with Frederick Hildner of Siam Portfolio Management.
It doesn't serve stability at all, so I don't think we need that in the financial system.
That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm Romaine Bostick, in for David Weston. One of the biggest margin calls in history led to the swift collapse of Archegos Capital. It's a fall from grace that has riveted Wall Street and has left banks from Zurich to Tokyo facing billions of dollars in potential losses. It's also providing plenty of second guessing and calls for regulations.
Incidents like this can shatter confidence.
Wherever you have excess liquidity, the potential, for accidents goes up.
Obviously, got to keep an eye on, is there more of this to come?
We see big banks de-risking, and we should take a page out of their book.
There's likely to be more scrutiny, more regulation. The banks, the financial markets are aware of that.
The family office of Bill Wang, a protege of Julian Robertson, collapsed after a series of wrong-way bets using borrowed funds prompted brokers to liquidate his positions. That liquidation, it involved selling several massive blocks of shares in Viacom CVS, Discovery, Baidu, and several other stocks. For more on the magnitude of this block trade blowup and what can be done about it, I spoke to Frederick Hildner, Siam Portfolio Manager.
I think the whole situation actually screams for more regulation, and for sure it will need an investigation, a proper investigation, because we have heard earlier that there are limits and boundaries to what a single investor should be able to do in terms of leverage. And I think this unprecedented situation calls for a deep dive, and like I said, probably will end up in more regulation.
When we talk about the massive leverage that we saw with Archegos, is that type of leverage normal for funds of his size?
I mean, I can't speak for them because we are long-only asset managers, fundamentally driven. We would never leverage, but I think it's way too much. And the way it was obviously a little bit hidden is not something that serves financial stability.
Well, when you talk about the hidden part, a lot of this had to do with the way that his positions were structured using swaps and derivatives, positions that would basically have allowed him to conceal just how exposed he was to the underlying stocks. How common is that? And is there sort of a call out there to prevent that or to minimize folks from doing that?
I think the equity swaps and CFD market as such is quite small as compared to other usual swap transactions. And therefore, most probably it went a bit under the radar, but certainly needs some more light on this particular niche. It doesn't serve stability at all. So I don't think we need that in the financial system.
Do you think that it puts managers like yourself or other companies out there at a disadvantage, at a significant disadvantage?
I mean, what we've seen is probably not enough to move the needle for the market as a whole, but certainly it did in some affected stocks. But the good news is that the fundamental value of those stocks did not change as compared to prior to this event. The only thing that changed is the price. So as a fundamentally driven investor, we see the price dropped. the companies are still doing good, and so therefore they are today cheaper than they were last week. That's the good news.
Well, on that fundamental point, though, there are some people who would say that the valuations that we saw prior to the sell-off was maybe a little out of step with those fundamentals here. How do you reconcile that?
Well, it's probably, in terms of multiples, true for larger chunks of the technology market as such. But you can also justify this because of the growth, etc. I mean, that's an ongoing discussion between value and growth and everything. Yeah. But I would not look at these particular affected stocks as being overly rich as compared to the rest of the market.
Are you worried at all about any systemic risks?
No, I mean, this is really unprecedented, and it will have some fallout in the coming days. It will be very interesting to see how the risk management systems in the affected banks worked or worked not so well. But as a whole, it's not enough to move the needle for the market as such.
And that was Frederick Hildner, portfolio manager at Siam. Coming up, global trade is on the move again in the Suez Canal. The Ever Given freed. We talk about the impact on global oil markets with Paul Sankey of Sankey Research and Dan Jurgen of IHS Markit.
One hopes that this was a one-time event, but it was a very big one-time event.
That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm Romaine Bostick, in for David Weston. After almost a week jammed in the Suez Canal, the 430-yard container ship known as the Ever Given finally freed. This is allowing cargo ships to resume their journey on the shortest route between Europe and Asia. Paul Sankey, lead analyst for Sankey Research, discussed the impact on the global oil market.
Actually, to be honest, not a lot. I mean, we aren't importing a lot of Middle Eastern crude into the US, which in the past would have been a very big number. If you look back 10 years ago, we could have been getting up to 2-3 million barrels a day through the Suez Canal all the way from the Middle East. That number, as you know, is much, much lower. And if anything, it was more of a disruption to trade and somewhat to the petrochemical market in the other direction, with naphtha being really the biggest product that goes through the Suez Canal in the other direction. So overall, the impact on oil markets actually has been pretty muted.
I am curious, when you look at the trend that we've seen in oil prices, at the start of this month, I believe in that first week of March, we had Brent crude over $70 or $71 a barrel, I believe, at one point on an intraday basis. It's obviously come down a bit since then. It kind of been in a holding pattern. I'm curious as to sort of what you think traders and investors might be sort of waiting for as the next potential catalyst that could potentially move prices.
Yeah, that's a great question, because what happened in that run-up that you mentioned was that really we got to where the dollar implied oil at about 65, and oil was well below that, but the dollar had weakened considerably. Additionally, we obviously had the potential for significant shift in demand coming up as we head into summer, particularly in the US, but also in Europe. So with the Saudi attack that we had right when we peaked, actually, the dollar at that point started to strengthen, and if anything, implied that oil should be back towards 60, which is more or less, as you highlight, where we've moved to. And now everything's somewhat in equilibrium. The problem that we've had over the past 2 or 3 weeks has unquestionably not been US COVID, further to what the president was just saying, but actually the situation in Europe. So 2, 3, 4 weeks ago, we thought that both the US and Europe would be rapidly coming out of COVID. Whatever they say about cases in the US, the fact is that deaths are down considerably and hopefully staying down, and obviously activity is rising rapidly. So that part of the bull equation, the catalyst of going into summer, was working. The problem is that on the European side, it's not, and that's been delayed. And so what we found is that with the physical market for oil pretty weak, led by Europe, people have been worried that oil actually needs to fall back a bit more here. And so we stay in this equilibrium, I think, really until Europe starts to recover rapidly. And we get, for once in my 30 years that you mentioned, Europe is actually the tightening mechanism on the entire global oil market, which we've really never seen before. And we really hope that they can get their act together in terms of getting through COVID.
That was Paul Sankey, lead analyst for Sankey Research. Let's get another perspective now on the geopolitical importance of the Suez Canal with Dan Jurgen, vice chairman of IHS Markit and the author of the new book, The New Map.
All through the 20th century, the Suez Canal was primarily the highway for oil going from Middle East to Europe. Of course, now more Middle Eastern oil is going towards Asia. It's still important for oil. It's still important for LNG, but it's become much more important as the highway between Asia, particularly China, and Europe for container ships, of which the Ever Given was a particularly large example. And 50% of the tonnage going through the Suez Canal are container ships, 18% are oil.
And we've seen, though, these container ships, get larger and larger, and the capacity on those ships, including the same size, have also sort of increased as well. I'm wondering how much that factors into potentially what happened about a week ago, and whether it maybe presages the idea that we could see something like this happen in the future.
One hopes that this was a one-time event, but it was a very big one-time event. The main explanation being given now is that all those containers, and that ship can hold up to 20,000 containers, acted like a giant sail and caught the wind and pushed it over. Obviously, there are going to be investigations where there are also mistakes made in terms of operations and so forth. But these are very large ships going through the canal, and they depend upon it. And, the container ships have gotten bigger and bigger. In the new map, I refer to them as China's treasure ships, kind of referring back to the Chinese treasure ships of the 15th century when China ruled the waves. And those containers, that's really the foundation of China's position as a workshop of the world.
That was Dan Jurgen, vice chairman of IHS Markit. It's time now to take a look at what's coming up next week on Global Wall Street.
Romaine, while PIMCO is warning of an inflation head fake and HSBC argues that consumer prices are nailed to the floor in Asia, we'll get China's inflation report next Friday. Upward risks are seen for India, with Moody's saying inflation there is uncomfortably high and a challenge for the RBI, which is to decide on policy next week. Now, the central bank has been on pause since last summer over inflation concerns. The RBA, on the other hand, is unfazed by transitory blips in prices and has insisted that rates will not rise in Australia until at least 2024. We'll hear from Governor Lowe on Tuesday. And as we have seen chip prices rise on this global chip shortage, Samsung's earnings will be front and center. Danny?
Thanks, Sophie. In the UK, the latest COVID data is going to be important over the next week as the country plans to open outdoor dining on the 12th of April and has just allowed for small outdoor gatherings. On Thursday, we'll also get a look at the ECB's thinking when they publish minutes from their latest meeting. Scarlett?
Thanks, Danny. As you and Sophie mentioned, it'll be a big week for the world's central bankers and other policymakers. The IMF World Bank will be gathering for its spring meetings, virtually of course, and on their agenda, the economic recovery, climate change, and inclusivity, along with a proposal to create a fund to help developing countries cope with the virus. At midweek, investors hoping to get more color on the Federal Reserve's last policy decision will get their chance when the minutes of that meeting are published. And based on what happened last year, watch for a potential annual shareholders letter from Jamie Dimon. The JP Morgan CEO usually shares his views on the state of the economy, the banking industry, and public policy. Romaine, back over to you.
All right, our thanks there to Sophie, Danny, and Scarlett. Coming up, former Treasury Secretary Larry Summers reacts to President Biden's infrastructure plan.
I think this is very, very much in the right direction.
That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm Romaine Bostick in for David Weston. Build Back Better. President Biden in Pittsburgh this week making a pitch for a broad nationwide infrastructure plan.
It will create millions of jobs, good paying jobs. It will grow the economy, make us more competitive around the world, promote our national security interest, and put us in a position to win the global competition with China in the upcoming years. It's big, yes. It's bold, yes. And we can get it done.
It's a sprawling four-part program Spread out over 8 years, it includes traditional infrastructure projects, plus spending for R&D, broadband, and so much more. I spoke to former Treasury Secretary and Bloomberg Wall Street Week contributor Larry Summers.
Building Back Better was the central theme of Joe Biden's presidential campaign. It's what the country needs. This is all very much on the right track. I'm particularly excited about the infrastructure investment program. I'm particularly excited about the green aspects. I think we've seen in this Zoom era how important it is to universalize broadband to reach every American. These are investments that are going to pay off in a growing economy and are going to, I think, generate significant tax revenue down the road that they have not taken any credit for. These are investments that are backloaded. Very little of this money is going to be spent in the next several years when I think overheating is a substantial risk. So I think this is very, very much in the right direction. Frankly, I'd have liked to see infrastructure investments and green investments closer to the scale that the president talked about during his campaign, because I think both on building the economy's capacity grounds and, frankly, after this current period when we're likely to have an overheat and secular stagnation returns, we could do more. But as you said, the president's going to be unveiling his plans in several stages, and we don't have the full picture yet. But on net, I'm encouraged by what I see.
Well, you've had the era of presidents in the past and other policy makers here. And so when you talk about these sort of grand economic proposals, just with regards to the political will to get this type of stuff done, is it better to do these sort of grand proposals, these sort of where you're sort of doing it in these big blocks, these big stages, or is it more important maybe to narrow down the focus and say, just pitch something that's only on renewable energy and then come back and maybe do something that's only on something different? What's the approach?
I don't presume to have any sense at all that I'm going to be able to judge the way to get things through Congress better than Joe Biden. And I can't imagine a better advisor than his chief of staff, Ron Klain, who has immense advice and experience on these matters. And my former colleague, Brian Deese at the NEC, these are people who've got decades of experience in managing their way through the political system. In general, I think combining things is likely to be a good idea. It's likely to be a good idea because it lets you tap into multiple different sources of support. It's likely to be a good idea because it's such a lift to get anything through, particularly the Senate, given all the procedural ways of delaying things, that I think creating a combination is a good idea. I was worried that the previous bill didn't have any public investment and thought that public investment should have been combined into that bill. So, but I might have been wrong about that. I think the crucial point is that combining these things is very much the right thing. Are these exactly the priorities I would have pursued? I think I would have emphasized more the infrastructure and emphasized more the green investments, given the threat to the planet. And I probably would have put less emphasis on some of the other investments in the bill, though to be clear, I do not mean to slight the R&D investments, which I think are profoundly important as we compete with China. You know, I think the president said something immensely important about a week ago at his press conference.
What's that? When
he said that what's at issue in U.S. domestic policy is the viability of democracy as a government model. And the more we are able to make investments that show that we can stay true to our political traditions and also be the economy that delivers best for the mainstream across our society and all its elements, the stronger we're going to be globally at a time when we're being tested.
I am curious, though, when we talk about paying for this, we've seen a major part of this proposal is raising the corporate tax rate, that effective corporate tax rate, to about 28%, up from around 21% where it is right now. No doubt that that's going to meet some resistance here. But we've heard from Deese and others who basically said, look, this is an investment, and over time it will somehow pay for itself, and that increase in taxation, that somehow there'll be some benefit, not only to society, but to those companies as well.
Look, we are collecting only 1% of GDP in corporate taxes. That's perhaps less than half of what we used to collect. The business community's wish list was only to get the corporate tax rate down to 25%. And the 21% was some kind of fluke driven by President Trump that the business community had not even asked for. I defy any serious analyst to suggest that an excess cost of capital is an inhibition to any important private investment in the United States today. That's always been the traditional argument against a corporate tax increase, that it'll raise the cost of capital. But if you look at where price earnings ratios are, if you look at where the interest rates, real interest rates are, if you look at the fact that there's first year write-off, and so the value of all the deductions that people get when they invest goes way up with this change, I don't think it's plausible to argue that this is going to substantially damage investments incentives. I think it's absolutely the right thing to have done.
I mean, it certainly makes perfect economic sense here, but you go back through time here, and we've seen other attempts here at raising that effective corporate tax rate, and it's pretty much failed. We've been on a downtrend here for quite some time, pretty much going back to the mid-'80s when we were above something like 30% here. You now have a corporate tax rate that, by most measures, is actually below the personal tax rate right now. Is there sort of a way where you can actually nudge that tax rate up, back up to pre-Trump levels, pre-Obama levels, even to a certain extent pre-George W. Bush levels, without actually getting the backlash that seems to already have started?
Well, I don't really understand what you're talking about, because the corporate tax rate was in the 30s through George W. Bush. The corporate tax rate was in the 30s through Obama. The corporate tax rate was in the 30s since through the Clinton administration. So I don't really see that there's substantial damage here. And I think that economists all understand that you have to look at the corporate tax rate also in line with the tax treatment of investment. And we've got unprecedentedly generous tax treatment of investment with expensing of equipment and expensing of intangible investments. The fact that they can be written off in the first year. And so if you look at the combined nexus, again, I repeat, I would challenge anyone to suggest that cost of capital is a substantial inhibitor to investment. There is an argument that some people will make that that people will relocate their income abroad in response to a 28% corporate tax rate. But that's why I've been so excited about the advocacy that Secretary Yellen has engaged in of global cooperation to ensure that we don't have ruinous tax competition through transfer pricing. Look, I'm someone who in Democratic administrations has spoken all the time about the importance of maintaining business confidence, about the importance of cooperating with business, who's been very skeptical of a variety of the things that Senator Warren and Senator Sanders have suggested. I am not concerned by corporate tax increases of this magnitude. I think they'll make us more fair. I think they'll inhibit a variety of tax sheltering activities. And that's before you even get to the substantial benefits that are going to come from accelerating the electrification of the economy, from repairing a infrastructure that in many ways is a national embarrassment.
Former Treasury Secretary and Wall Street Week contributor Larry Summers there. Coming up, ECB President Christine Lagarde on Europe's next policy steps. This as the continent struggles to get out of the grip of the coronavirus.
They can test us as much as they want. We have a mandate, we have an aim. We're going to be riveted to that.
That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm Romaine Bostick, in for David Weston. Central bankers and policymakers around the world continuing to reassure investors they're going to be there for them as inflation risks rise.
I've said several times about this inflation debate. On the one hand, my base case is I think you'll see inflation moderate as we get through 2021 and into 22 and 23. But I also think it's wise as a central banker to have a good dose of humility and an openness to learning as this all unfolds. This is a lot of what's going on now is unprecedented, and I think the smartest thing I can do is keep an open mind, be humble, and be open to learning and adjust my views as this unfolds.
Europe's economic recovery has lagged behind the U.S., with the continent bogged down in slow vaccination rollouts and extended lockdowns. Yet borrowing costs, they're still rising. That's forcing the ECB to accelerate emergency bond buying. The president of the European Central Bank, Christine Lagarde, spoke exclusively to Bloomberg's Francine Lacqua.
We are very attentive to these financing conditions, from upstream to downstream, meaning that we look at the risk-free interest rates, we look at all the sovereign bond yields, we look at the credit terms that are available for consumers, for investors, for corporates. And then we determine on that basis whether we should adjust one way or the other. Because don't forget, given the exceptional situation that we are facing, we are using maximum flexibility when we deploy PEP. We will deploy all of it or not, or more. And we will certainly adjust as needed, depending on these financing conditions that we monitor and that we evaluate very carefully.
But as the economy recovers, bond yields will rise. How will you determine what's warranted and what's not warranted? How difficult is it to determine?
What we observe at the moment is yields that have increased quite significantly and quite rapidly. And this is what has guided our most recent monetary policy decisions. The next worry when yields rise because the economy is picking up, because consumers are consuming, because investors are investing, and because hopefully there will be a bit of price pressure exercised on our economy, then we will assess what is needed. But let me tell you this, given the distance relative to the aim that we have, which is inflation, I think that it's going to be quite a while before we actually have to ask ourselves whether we need to tighten at all.
What's quite a while? A couple of months, or could it be longer?
That is something that will be determined by our observations of facts, of prices, of indicators, and we are not going to be guided by the short-term movement, because we know that in the short term, inflation is going to rise. There are some technical, temporary factors that are going to lead to upward price pressures. That is going to be caused by multiple elements, whether it's the German VAT increase, whether it's the rebalancing of weight in the inflation assessment basket. But we're going to see through that, because those are not sort of underlying fundamental factors that will increase prices in a consistent and convergent fashion. So this will be guided by observation of sustainable, solid movements, and by our aim, which is price stability as defined, and our commitment to economic players that we will preserve favorable financing conditions.
Mario Draghi never got to hike rates. Could you imagine being in the same position?
We shall see. Future will tell, as the song would go. I would certainly hope that the economy is going to pick up, that there will be a turnaround in the months to come, and that we will be able to resume our sort of less exceptional monetary policy going forward. But I'm not seeing any kind of raise in the near future for sure.
Madame Lagarde, what are markets exactly playing at the moment? They seem to be continuing testing central banks. Like, how steep of a yield curve is it okay?
They can test us as much as they want. We have a mandate, we have an aim, we're going to be riveted to that, and we're going to do what is required in order to deliver on that. And we have exceptional circumstances to deal with at the moment, and we have exceptional tools to use at the moment, and a battery of those. And we will use them as and when needed in order to, as I said, deliver on our mandate and deliver on our pledge to the economy.
Coming up, as Wall Street weighs a return to the office, top banks are starting to make a few concessions to lure their employees back. That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm Romaine Bostick, in for David Weston. After more than a year, Wall Street, grappling with when and how to bring back all of its workers to the office, is not only about the physical presence, but about what the banks deem best for productivity and what employees deem best for their well-being. And that has led some financial companies to put a few curbs on those legendary work weeks. Wall Street is realizing the toll the pandemic is taking on employees and on managers who have had trouble making the distinction between the home and the office. Fresh light was shed on that issue in mid-March when a survey by a group of first-year analysts over at Goldman Sachs made the rounds on social media. The survey highlighted 100-hour work weeks and complaints of deterioration in physical and mental health. Goldman CEO David Solomon responded by promising to do a better job of keeping young bankers out of the office on Saturdays. That was part of the wave of financial firms attempting to show their empathy and appreciation for their employees. Jefferies offering its youngest workers coveted fitness perks, including Peloton bikes. Citigroup CEO Jane Fraser barring internal video calls on Fridays, a day that will now be known as Zoom-free Fridays. Over at Apollo, that company putting money where its mouth is, offering six-figure bonuses to retain some of its associates. Now, some skeptics of these announcements wonder why it took a year for them to finally realize and address the pandemic's effect on their staff. It may actually have more to do with Wall Street's tough competition with tech companies for talent, especially as Silicon Valley has embraced the work-from-home or hybrid model more fully.
The productivity lift you get if people have the ability to work from home some days, be in the office, in particular when the rest of their team or more broadly teams are in the office. And if you can save people commute time, you have better access to talent because you're solving what people want in their personal life, it's actually going to result in a better outcome.
As most of Wall Street still charts the path back to physical offices,
there are huge weaknesses to the Zoom world. I mean, most of us learned by an apprenticeship system, by seeing mistakes, going to trips, how do you handle a client, how do you handle a problem. So it's hard to inculcate culture and character.
The future of work is shifting right in front of us. As the pandemic remains, 2021 will chart how global workforces move forward. From the way Wall Street works to Wall Street trying to help small business, Bloomberg's Sonali Basak and I spoke to Margaret Anadu, the head of Goldman Sachs' Urban Investment Group. We talked about the bank's efforts to grow minority-owned firms and fix the major disparities in small business.
What is the fix? If you had to walk through what the role of the financial system is here, and also recognizing, has the financial system left communities of color behind for so many years? How do we address that?
Well, I mean, I don't think anyone would argue that there hasn't been significant disinvestment in Black communities for decades. And part of that is around flawed government policies going back to even the 1920s around redlining and certain issues around who could get a mortgage and who couldn't. I think what we're doing here is reversing exactly that. We want to invest, right? You said the number, $10 billion to solve some of these issues and narrow some of these gaps. So that's about focusing on Black entrepreneurs. That's about focusing on Black neighborhoods and communities and the infrastructure that's needed there, the housing, the healthcare facilities, the educational facilities, fresh food, really all that's needed in these communities to start to reverse those trends and put capital in the hands of those communities, in the hands of those community anchors to start to reverse those trends.
Well said. And I mean, this isn't just a moral issue. You're just not going out there and making a moral case for this. There is an investment case. There is an economic case here that this is just basically smart investment. Kind of explain here the pitch that you make to people who maybe aren't as like-minded on the moral issue, but can maybe understand the economic issue.
Oh, absolutely. So this is first of all, this is built on decades of investing that we've been doing in this work. So going back 20 years now, we have been working with community stakeholders, incredible entrepreneurs, not-for-profits, development partners who understand the challenges in these communities, but more importantly, see the value in these communities. So this isn't, we're very proud about this. This is an investment strategy.
Margaret Anadu of Goldman Sachs and Bloomberg Sonali Basak there. Finally, one more thought. March Madness. The NCAA college basketball tournament has whittled through 68 teams to the Final Four standing. Now, whether you're a sports fan or not, just know, even in a pandemic, college basketball is still big business. More than 80% of the NCAA's $1 billion in annual revenue comes from this one tournament, and the more than dozen cities that typically host this 3-week-long tournament of games really get a nice boost to their economies from the influx of athletes, fans, the media, and whatnot. But of course, this year, because of the pandemic, spectator attendance strictly limited and no traveling from city to city for any of the teams this year. All the games being played in Indiana. And well, that's good for Indiana. A $100 million economic boost from hosting the entire 68-team tournament in central Indiana this year. That's good news for a state projected to have lost more than $330 million in state and local tax revenue from hotels during the pandemic. Lieutenant Governor Suzanne Crouch, she told Bloomberg Tax, "We're looking at the tournament as a shot in the arm," no pun intended. Before the pandemic, travel and tourism, it funneled more than $80 billion in tax revenue annually to state and local governments nationwide. And sporting events, they were a big driver of that before the pandemic shut it all down. Now, fortunately, things are looking brighter. As the NCAA wraps up its tournament, Major League Baseball began its season this week, and yes, there were fans. A limited number allowed, of course, but there were still fans in the stadium, and hopefully people checking into hotels, eating out at restaurants, and boosting those economies. That does it for this episode of Wall Street Week. I am Romaine Bostick. This is Bloomberg. See you next week.